All right, let's talk about a word you hear thrown around all the time, usually when something bad is happening in the financial world: derivatives. But what if I told you the whole idea, this huge complex thing, boils down to something as simple as a cloth bag? Let's dive in.
So, a cloth bag, an airline ticket, and an insurance policy. What could they possibly have in common? I know, it sounds like the start of a really weird joke, but trust me, the answer is the key. It's how we're going to unlock this massive, multi-trillion-dollar world of derivatives.
Okay, first things first, let's forget Wall Street, forget the complicated charts, and all the jargon for just a minute. To get right to the heart of what a derivative is, all we have to do is answer one really simple question. What's in the bag?
Okay, so here's the official textbook definition for you. A derivative is a financial contract whose value is, well, it's derived from something else, an underlying asset. Now, that one word, derived, that's everything. It sounds a little floaty, a little abstract, I know, but stick with me because our bag example is going to make this crystal clear. All right, so picture this. You've got a simple, plain cloth bag, nothing special at all. By itself, what's it worth? The value of the cloth, maybe the sticking, let's just say 10 rupees. Super simple, right? But now, let's do something interesting. We take a stock share, a piece of paper worth 100,000 rupees, and we place it inside that bag. Suddenly, who cares about the 10 rupees of cloth, right? The real question is, what are you holding in your hand now? What is that bag truly worth? And that is the whole idea right there. The bag itself, the cloth, it's still just worth 10 rupees. But its total value is now completely 100% derived from the stock that's inside it. If the stock price shoots up, the value of what you're holding shoots up. If the stock tanks, its value tanks. The bag has become a derivative. Its own value is tiny, but its entire purpose is to represent something much, much bigger. Okay, so we've got the basic concept down. It's a container whose value comes from what's inside. But where did this idea even come from? You know, derivatives weren't invented by some traders in a skyscraper looking to make a quick buck. Nope. They were actually born out of a very real, very practical problem that businesses faced. How on earth do you lock in a price for something you need in the future? So let's put ourselves in a real-world scenario. Imagine you're running an airline. What's your biggest headache, your most unpredictable cost? It's jet fuel for sure. You know you're going to need millions of gallons a year from now, but you're terrified the price is just going to go through the roof. And you can't just buy it all today, right? I mean, where would you even store it? So, what do? How do you protect your company from that massive uncertainty? Well, this exact problem is where the first type of derivative comes into play. It's called a forward contract. And honestly, it's a pretty straightforward agreement. The airline just finds a seller and they agree on a price today for all the fuel they'll need delivered a year from now. That's it. Both sides sign on the dotted line and they are legally locked in. No matter what the market does, that's the price. And you can see how powerful this is, right? Just by signing this one contract, the airline has basically erased a huge chunk of its uncertainty. It has locked in its fuel cost for the entire next year. So if the market price of fuel doubles or even triples, who cares? They get to buy at their much lower agreed-upon price. They've just used a derivative to turn a wild, unpredictable risk into a nice, stable, fixed cost. And in the world of finance, there's a word for that. It's called hedging. Okay, so that private custom deal worked perfectly for the airline. But what if you can't find someone willing to make a special deal just for you? Let's bring in a new character to help us explore the two main places you can go to make these kinds of agreements. All right, let's meet a soybean merchant. He has a very specific need. He needs exactly 100,000 kilograms of soybeans, and he needs them delivered in exactly 6 months. That precision is key here. So where does he go? Who can help him lock in a price for that specific order? Well, he basically has two choices, two different marketplaces. On one hand, you've got what's called over-the-counter, or OTC. This is just like what the airline did, a private, custom-made forward contract. He can get his exact amount. The downside? It's all based on trust. There's a real risk the other person might back out. Then, on the other hand, he can go to a public exchange. Here, the contracts are all standardized. Maybe they only sell in lots of 70,000 kilos, so it's not a perfect fit. But the big advantage is that the exchange itself guarantees the trade. There's basically zero risk of the other side defaulting. These standardized contracts are called futures. So you see the trade-off, right? It's customization versus security. So let's recap. With forwards and futures,
Both people are locked in. They are obligated to go through with the deal, for better or for worse. But what if you wanted something a little more flexible? What if you wanted the protection from prices going against you, but you also wanted the freedom to walk away if, say, you find a better deal somewhere else?
Just think about it for a second. With a futures contract, you're locked in. If the price moves in your favor, awesome. But if it moves against you, you're still obligated to take that loss. So the big question is there a way to have your cake and eat it too? Could you keep all of the potential upside, but somehow just get rid of the downside risk? Well, the answer to that question brings us to the next big evolution. The option. An option is a total game changer because it gives you the right, but, and this is the most important part, not the obligation to buy or sell something at a set price. Now, that flexibility isn't free. You have to pay a small fee up front for it, which is called a premium. The best way to think about it, it's almost exactly like buying an insurance policy. This right here lays it all out, nice and simple. With a future, it's a must. The buyer must buy, the seller must sell. It's a two-way street, a firm obligation for both sides. But with an option, the buyer can choose to buy. They have the choice, the power, and only if they decide to use that choice is the seller then obligated to sell. All the control is in the hands of the person who bought the option.
So we've seen this incredible journey, right? From these simple handshake deals between merchants to these really sophisticated, complex financial tools. But somewhere along the way, something fundamental changed. Their purpose split in two, and they became this incredibly powerful but also incredibly dangerous double-edged sword.
I mean, this has been a long time coming. We're talking centuries ago. You had merchants just trying to get a fair price for goods they needed later. Then a huge leap forward in 1848 when the Chicago Board of Trade created the first formal futures exchange. But the real explosion, the moment everything changed, was 1973. That's when financial options hit the scene, and that just blew the doors wide open for all sorts of complex strategies, leading us to the massive market we have today. And that brings us to the absolute heart of the matter. Today, derivatives are used for two totally different reasons. On one side, you have hedging. That's the original purpose. That's our airline, using a contract like an insurance policy to protect its business. But on the other side, you have speculation. This is completely different. This is when someone uses a derivative just to place a bet on which way a price is going to move, purely to make a profit. They have zero interest in ever actually owning the jet fuel or the soybeans. And this really gets to the core paradox of it all, doesn't it? For a huge global company, they are an absolutely essential tool for managing risk. They make business possible. But in the wrong hands, the insane amount of leverage they provide can cause unbelievable financial destruction. It's how they earned that infamous nickname, weapons of mass wealth destruction. So where does that leave us? What are they really? Are they a vital tool for creating stability in a chaotic world? Or are they just a glorified high-stakes casino? And the craziest part is, the answer is yes, they're both. They are a tool for stability, and they're a tool for gambling. And understanding that split personality, that duality, is maybe the most important thing to grasp about modern finance.